What's up everybody? Welcome to the Stocks channel. My name is Corey and today we're going to do macro technical analysis and we'll look at all of the indices, the VIX and Bitcoin. Today I'll give you my view on where I think the stock market's going from here and which critical levels to pay attention to. So first up, let's take a look at a weekly chart of the SPX S&P 500 index. So let's crack open this chart and see what's going on in the stock market today. Alright, so remember these are weekly charts, so every single candlestick on this chart does represent one entire week's worth of price action. So there's just a couple of things I want to start out this week's episode going over, and the first one is going to be this time cycle study. So remember that time cycle study did bottom out last week, and we do expect to see some sort of buying pressure coming in from this low. You can see that we did end this week higher in the green, a little bit higher than the cycle low week, so we're starting to see that buying pressure now. Remember, these cycles don't guarantee anything, but this time cycle in particular does have a good rhythm of the stock market and has been calling some very critical lows. And even when we didn't get a low back in June, we could see that there was a very strong bull trend and we continued to go higher from there. So we're very clearly seeing the weakness in the market coming at the bottom of the cycle, and we could be seeing a lot of strength coming from here. Now we could see a lower high and the rest of this cycle could lead to another lower low. So we still need to be very cautious and not get overly bullish because we are in a short-term downtrend until we're not. So I'm going to go ahead and hide this time cycle study because that's all I need to say about that. The next thing I want to go over is the fact that I do think the year 2022 will see the SPX up here at 5,100. So the reason I bring this up is because if you have a long-term outlook of the market, and you agree with me that it is going to SPX 5100, or at least for the time being, we can all agree this is a stock market correction, and after a correction, we should resume the macro level bull trend. So the reason I bring up the yearly price target is because that represents opportunity. If you are buying during the stock market correction, you are buying low, knowing when we come out of this hole, we are going to eventually hit that price target, which is now a 15% upside. If we continue to go lower and we break through this support level at 43.50 and we go down to 41.58, now if you're buying at that level to the price target is now a 22% upside. So this is why it's so important to understand where the stock market is going and not just where it's currently at. It's very simple to get overly emotional while the stock market is drawing down and get very fearful and start panic selling your positions. But if you're a disciplined long-term investor and you don't mind holding your position for a longer term period, these are the times that you should be getting very greedy and starting to load up. There's going to be people out there that say that's a bad idea because look at the dot-com bubble and look how many years went by before you broke out to a new all-time high. But I would say that that is completely irrelevant because if you're in it for the long term, the lower the stock market goes and the more you're able to accumulate, the much better off you're going to be when it finally does break out and start running to new all-time highs. So I'm putting on my investor hat here and I'm telling you that the lower the stock market goes, if you don't need that money in the next 10 years, you should be buying more and more and not worrying about the short term. Remember that you are buying the S&P 500, which represents the best companies in the world, and you are essentially betting that those companies will continue to grow and the stock market will continue to go higher as a result of that. So unless you're doom and gloomy and think the end of the world is coming, you should continue to buy low and you should continue to hold on for the long term. If you are a trader, I still suggest you have a long-term position that you're tracking the indices with, because if your trading goes against you and you start making a lot of losses, your investments will be there to save you and you'll still be tracking to the market. So I'm not going to tell you you have to buy at these levels. Obviously, use your own risk management and do whatever's right for you. But I think the stock market is very attractive at these levels. So the last time we talked, I did mention that we were in a correction and it's just a matter of how low are we possibly going to go. And I gave you 3 very critical levels. I told you to watch 4,500, which we obviously closed below 2 weeks ago. And then I told you to watch 43.50, 41.58, and right around 4,000. Well, as you can see, the weekly 50 EMA was being violated intra-week and we were below the weekly Bollinger Band, and there was a lot of buying pressure that came in and we did close back above 43.50. So for the time being, anytime you see a very bullish reversal candle like that, there's always going to be the possibility that that was the bottom. I'm not guaranteeing that that was the bottom, but you can clearly see a very bullish looking hammer where there was a lot of buyers at these lower levels and we closed back above the weekly 50 EMA. Now you do need to remember too that we no longer have the bull trend on the weekly chart, so we are getting into a market that might need to go sideways before it can go any higher. So essentially what I would be expecting from here is I would not expect to see a straight run up to new all-time highs in a straight line. I think because we lost the weekly bull trend, we're more than likely going to a lower high, and then we'll need some period of consolidation, eat some time off the clock, and let a lot of people get fearful in this market let a lot of people sell their positions. That will add a lot of liquidity back into the market. And then I think we will continue to go higher and hit that price target, which does mean these are all going to be buying opportunities. And the second half of the year should be very bullish. So as you can tell, based on how I'm drawing out this consolidation period, it is going to be somewhat of a wedge or a consolidation period on the weekly chart. And in the short term, we are more than likely going to continue to go higher during earnings season. Remember, earnings seasons don't guarantee we have to go higher, but if we continue to get strong earnings and companies raising guidance, we will see the bears starting to hibernate and we will see the market starting to rally higher from there. So because we lost a weekly bull trend, I favor this consolidation wedge pattern before we can go hit that target at 5,100. And another way to think of that is you don't need to rush into a decision. Take your time, make sure you understand how this year is going to play out, make sure you understand your plan accordingly, and then remember that you don't have to make any rash decisions and you don't have to decide anything tomorrow. This period of consolidation can take us all the way out into the middle of April and possibly even longer, and that does mean the strength in the short term you could sell into as a trader, but as an investor, I would strongly suggest that you don't try to time the market and just focus on getting good buying entries and then let time solve all of your problems and continue to ride those positions out. So I think that's going to cover most of the next few months in the SPX, so look for that possible price action. And don't forget, if we do start breaking down below the weekly 50 EMA, the next support level is down here right around 41.58 and 4,000 on SPX. That on SPY is going to be right around $418 and $400, so watch those levels closely. Keep in mind, if we do start breaking below SPY 420 or SPX 4200, it is going to significantly increase the probability we're going into a bear market. And that does mean if we go into a bear market, we may not see a new all-time high this year. So remember that everything I tell you is subject to change and we have to stay objective. I'm just talking about the chart that I can see in front of me right now. And the chart I can see in front of me right now looks like a stock market correction that is more than likely going to new all-time highs this year. And if that changes, I will update accordingly. But right now, this looks like a stock market correction in a bull market that wants to continue to go higher. All right, so the next thing I want to look at is a monthly chart of the SPX. Because we did lose the bull trend on the weekly chart, we need to now start looking at the monthly chart. So the first thing I want you to notice on the monthly chart is that we are still in a macro level bull chart, even though things are getting very volatile on daily and weekly charts. Now, when you view the stock market as a monthly chart, it's very simple to see that the stock market likes to go higher over time, and you don't typically have a lot of periods where you go down for consecutive months before you start going higher yet again. So if we take the example of the March 2020 crash, we can see from month high to month low on closing prices, we were only down about 20%. Obviously, from high to low, it was much more volatile, and at one point we were down about 35%. But if you look at monthly closing prices, that was still in the magnitude of a very quick bear market, going down 20% in 3 months, and we never actually went lower than that after we hit that low on the monthly chart. You can see the next month we did go lower, but we did close much higher, and we can see in a macro level view that the March 2020 crash was just a blip on the radar. And if you were an investor and you held through that volatile period and you did not panic sell at the bottom, you were quickly rewarded because we were back to new all-time highs only 5 months later. So I'm not trying to predict anything about where we're going from here. I'm just trying to teach you to have an open mind. And if you look at the stock market in larger term periods, it's a lot easier to not get overly emotional. So when you look at this monthly candle, at one point we were way down here at 4,200 and it was starting to look like the world was ending and we were coming straight down to 4,000 in a hurry. You can now see the buyers of the dip are coming in, and we do have one more trading day in the month, which will close the trading month on Monday. So if on Monday we can close back above SPX 45.35, we will have not even broken down below the monthly 5 EMA. So when you think about that on a macro view, it will just be another blip on the radar, especially if we continue to go higher from here and break out and try to form new all-time highs. So if you're mass panic selling near the bottom, and it's possible we close all the way back over the monthly 5 EMA, and then we continue to run the new all-time highs from here, you will have a lot of regrets, and you probably will have a lot of FOMO. So all I'm trying to teach you is that if you're selling down here, please do not buy up here. If you're selling at the bottom, do not be buying at the highs. It's not because any other reason than that is a very bad habit. If you're selling down here and you're getting fearful, that is completely fine if that's what fits your risk management and that's how you want to trade this market or that's how you want to invest. But what I don't want you to do is I don't want you to sell down here at 4,200 and then buy all the way back up here at 4,800. If you're getting in the habit of selling low and buying high, you will lose all of your money doing this, and you will not be doing this for very long. So do whatever fits your risk management, but if you're selling low, please do not be buying high. If you're buying low, you're much more likely to make money in the long term, and the more you make it a habit to buy low, the more likely you are going to make a lot more money than the people who are just trying to day trade constantly and constantly losing money. So if you think in the longer term, you should view the stock market as an asset that you want to own, and the lower it goes, the more of it you want to own. Think of it as a fancy luxury car that's $100,000 and it just went on sale for $75,000. Does that make you want that luxury car less, or does that make you want to buy that luxury car more? So the stock market is something you should want to buy more of the lower it goes. So don't let anybody scare you out of buying low, because that is not how you invest. If you're listening to any sources that are telling you not to buy low, you should really second guess that source of information, because if you're not being taught to buy low, what the hell are you being taught? You always want to buy low and you always want to sell high. Accumulate as the stock market goes lower, and then either scale out and start locking in profits as it goes higher, or just continue to let it ride for the long term. There's so many ways to be profitable in the stock market, and one of the easiest ways to do that is to buy low and then hold for the long term and then continue to sell higher. So looking at this monthly chart of the SPX, it does not look like it's time to panic. This looks like opportunity, and it looks like it's time to start buying. Now there's one more thing I want to do, is I want to go back and look at the 2018 taper tantrum, because it's a very similar scenario that we're in now. It's not identical because rates were not at 0% in 2018, and the Fed still talked about raising rates anyway. So back in 2018, we did see the stock market drop about 20%, but from month close to month close, we only dropped about 14%, which is well in the magnitude of just a stock market correction. As you can tell in that time period, that was a period of 3 months, and then the stock market did go back into another bull cycle. So what I want you to take away from that is, in this taper tantrum, we had about a same exact magnitude of drop that we're currently in. If this is just a sped up version of the taper tantrum, it is possible that we go back on the bull a lot sooner and that we don't have a 3-month drawdown. The other thing I want you to pay attention to is that if we do have a 3-month drawdown, you can see that there was a green month in between. So we had a drawdown in October, we bounced in November, and then we continued that drawdown in December, and then we went right back on the bull. So in this scenario, we're having a drawdown in January, we could bounce in February, and then we could continue to draw down to SPX 4000 in March, and then we could go back on the bull. So in the grand scheme of that, it would look like a monthly ABC down to 4,000, and then we would go back on that bull market to SPX 5,000. So don't necessarily rule out things that have happened in the past, because while history doesn't repeat, it often rhymes. And that was a taper tantrum back in 2018, induced by the Fed tightening and starting to talk about raising rates. It's the exact same scenario we're in now, and you can see the stock market shook it off and went higher, and usually the Fed does start to back off on some of their statements if they get overly hawkish, especially if we start to see the economy starting to weaken. So view the stock market in a macro level view as an investor, and if you're a trader, you should still have some investments, because if your trading goes against you, you want something there to back you up. So the last thing on the monthly chart I want you to see is that the 20 simple moving average is right around 4,000. So I don't expect to see the SPX trading below 4,000 this year. That is going to be an extremely strong support level on multiple time frames, and that should be an extremely strong support that I don't expect to see violated. So if at any point this year you see SPX around 4,000, I do believe that will be a screaming buying opportunity, because that will be a very nice ride back up to 5,100 of about a 28% gain. Okay, so the next thing I want to do is take a look at the Bear Bull survey, and you can see every week we go over this survey, it is becoming more and more bearish. We're now sitting at 52.9% of the people that are bearish, 23.9% are neutral, and only 23.1% of the people are bullish. So remember, this survey doesn't tell you anything about the short term, so it does mean with the bearish sentiment we could go down in the short term, but this is looking out about 6 months. I cannot think of a time where we saw this much bearish sentiment that in 6 to 12 months from now we were not significantly higher. Remember, this is a contrarian indicator, and you don't want to go with the majority, because the majority are usually wrong. So if 52.9% of the people are becoming bearish, this is the time to start thinking about getting greedy and starting to buy for the longer term. With 52.9% of the people that are bearish, you can walk into a 3rd grade classroom and ask one of the children if the stock market is going higher or lower from here, and they will be able to tell you that the stock market is crashing and their dad is losing a lot of money, so it's time to panic sell and get out of all of your positions. Remember, when everybody expects something to happen and everybody knows about the news and knows all of the reasons why the stock market's going lower, that is usually a great indicator that everybody is wrong and the exact opposite is about to happen. It doesn't guarantee anything, so if you don't want to be a contrarian, I completely understand. But more often than not, being a contrarian when you get mass fear readings like this is more often than not going to be the best time to start loading up. So looking at this much bearish sentiment, I think it does match my analysis that we don't have a lot more downside before significant more upside. Next, we'll take a look at a weekly chart of the NDX, and we can see the NDX is looking a lot more rough than the SPX, and we can see this drawdown from high to low is about 18%, and from weekly close to weekly close, we did have a full-blown correction of about 14%. So when you look at these weekly closing candles, you can see that we're still in the territory of a stock market correction. And if we do go much lower, we more than likely will see that bear market, which means we more than likely will not see a brand new all-time high this year. So from this price to my all-time high price target just above 17,000, we do have about 20% upside. And yes, I do think we are going to get to those levels this year. Now on the weekly chart, we can see we did lose the bull trend and we did close below the weekly 50 EMA. So the NDX is looking a lot weaker than the SPX. However, we still are holding above this low at the wave 4 low, which is right around 14,385, and so far we have not closed below that level. If we do close below that level, you can see the next support level is also holding up, which is right around 14,040, and if that level breaks down, we could be coming down to about 13,300. That would be the bear market scenario, and that means you're more than likely not seeing a new all-time high this year, but so far we have not closed below these levels, so we don't want to get overly bearish until we see price action closing below those levels. Remember, as an investor, even in a bear market, you're going to want to be buying, but as traders, it's a lot more important to go in the direction of the trend. So do remember, in the short term, the trend direction is still lower, and in the long term, the trend direction is still higher. We are making a lower low on the NDX weekly chart, so that's definitely something you don't want to completely ignore. So on the NDX, we'll be looking a lot more bullish if we can start closing back above 14,700, and very bullish if we can start closing back above 15,653. On the Dow Jones weekly chart, we can see that we are monitoring this possible double top pattern, which means if we do see the Dow Jones closing below 34,000, we can't rule out the possibility that this was a double top and we need to go for a full leg lower. So that's definitely something to pay close attention to. So watch that very strong support level at 34,000. And if we break below that level on a weekly close, we will want to become a lot more bearish in the short term. So closing below 34,000 means we could be going all the way down to about 32,000. And then the next support on the way there will be right around 33,000. You could see that we are losing the weekly bull trends, so that we are going to see a very choppy market, and we're more than likely not going to see a V-shaped recovery to a brand new all-time high until we can get through a period of consolidation. On the Russell 2000, you can clearly see that we are in a bear market, and from the high to the low, we have had a drawdown of about 21%, and from weekly close to weekly close, we've had a drawdown of about 19%. So this is still in the territory of a deep correction, even though from high to low, we are in a bear market. So keep in mind, the small caps don't really tell us anything about the rest of the market because the large caps drive the stock market higher and not the small caps. So it is possible the small caps do go into a bear market while the large caps continue to trend higher. But you can also tell from the Russell 2000 that we are coming into very strong support levels right around 1930, and below that we're more than likely coming all the way down to 1700. However, because we are at strong support, there is the possibility of a counter trend rally, and we know all bear markets have very strong counter trend relief rallies, which does mean we could see the Russell 2000 coming all the way back up to about 2150 and testing that breakdown level as resistance before going any lower. If at any point we see the small caps breaking back above 2250, that will be a lot more bullish, but I would not get bullish on something that's in a bear market. This is strictly something you should be looking for as trading only and looking to short at resistance if we do get rejected. On the VIX weekly chart, we can still see a lot of signs of caution with the VIX closing above 24 for 2 weeks, but we can also see a lot of signs that we could have seen the bottom. You can see this VIX weekly candle shows the VIX getting crushed all the way from a high near 39 all the way back down to 27. When you see a candle that's getting rejected this hard to the upside, that does mean that it could be getting crushed back down and we could have seen the top. So if at any point you see the VIX closing back below 24, that will be a bullish signal that we could be going back into a bull market, and the confirmation will be the VIX closing back below 20. But as long as the VIX is above 24, stay cautious and expect to see a continuation of consolidation and chop. On Bitcoin, we're currently trading right around 38,000, and we can clearly see Bitcoin is still looking very weak. And in the short term, we do have a very strong downtrend. Your critical support level on Bitcoin is 31,785 because if we break below that level, we're more than likely going back down to 20,000. You can round down to about $30,000 because there are some wicks in that level, and there's no doubt if Bitcoin is testing support, it will want to go a little lower than support and take out a lot of stop losses. So if you're bullish on Bitcoin in the long term, you might want to just go ahead and set up some bottom fishing limit buy orders, because it's possible we hit that level and do get a very impulsive bounce. But because we're no longer in a bull market, that bounce more than likely won't take us to a new all-time high. So watch for these resistance levels above at 46,000, 53,000, and then 60,000. All of those levels will be a lower high, so we'll need to break back above 60,000 to start getting a lot more bullish. But that doesn't mean we can't go higher in the short term, because like I told you before, all bear markets have a relief rally, and we still do need to form a lower high. So because of that reason alone, I think these are great buying opportunities, but you might need to consider holding for a few months to get the full maximum profit, based on the fact that it's going to take some time to reverse this downward energy and start trending higher yet again. If at any point Bitcoin breaks below 30,000, it's going to expedite a lot of selling, and you're going to see a very quick waterfall to $20,000. On the RK ETF, we're closing down around 69 this week, and we did close below 70, which does mean we can be going down to that next support level lower at 60. A lot of these levels could be the bottom in this bear market, but we won't know we saw the bottom until we see a bullish breakout, which is really a close back above 91. You can see it's in a very strong bear market, with all the moving averages stacked to the bear side and price action slicing through all these support levels, and we are reaching capitulation. And you can see by the volume that we did see a ton of volume this week, so that usually is an indication that we're getting very close to the bottom. A lot of people are panic selling and capitulating, which means a lot of people are more than happy to start buying because they know the sellers are getting exhausted and it's time to start going higher from here. So in the short term, it is possible to see a very impulsive bounce. Look for resistance right around 81 and 91, and we'll be getting a lot more bullish above 91 and 99. So jumping back over to the S&P 500, it's very important during these periods of volatility that you stay objective and don't let fear creep into your trading. Fear mongering is always going to be out there, and there's always going to be a talking head out there telling you to not buy the dip because it's too risky. You define your risk, you define your risk management, and you define when you think it's comfortable to buy and when you think it's comfortable to sell. I'm also just a talking head, just giving you my opinion, and that doesn't mean you need to listen to anything I say, and for that matter, you don't need to listen to anybody else except yourself. So don't let anybody scare you out of doing anything. Do exactly what fits your profile and exactly what makes you feel comfortable, and make sure whatever you decide that you have no trouble sleeping at night. This is going to be a very choppy market, and the volatility is not gone just yet, so we're not out of the woods. Even though in the longer term, I still think this is a bull market, and I still think we are not going to see the top for many years to come, and we're going to continue to grind higher. So I'm a buyer at these levels, and I have very strong conviction, and that's why I'm not afraid to share my opinions. Also, don't forget that I do offer Bank Trade Alerts, which is an algorithm-driven trade alert service that sends all of your buy and sell alerts directly via email and text message, and only trades the ETF TQQQ. Bank Trade Alerts has never had a negative year and beats the market every year, and even in a bear market like 2008 when everybody was losing money, Bank Trade Alerts beat the market and made over 90% that year. With all the recent market volatility in a brand new trading year, I think now is the best time to be a bank member. You can find out all of the information and how to subscribe by clicking on the link in the description of the video. I also have the Stocks Channel Discord where I do intraday updates and analysis and bring new trade ideas to you weekly. If you're interested in joining the Stocks Channel Trading Discord community, you can find out how to join the Discord server by clicking on the link below. So thanks for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.